Hello everyone, welcome back again to my channel SN Study Station. So this is Sana Naim and today we are going to start new topic, that is cost of capital. Okay, so if you are a finance student, then you may have heard about this topic, and if you are watching the video just with the curiosity what is there in finance, how we can start investing, how I can do investing, okay, where should I put my money so that I'll get profits. So for that purpose also it is beneficial for you. So cost of capital we are going to see under this video. So in this session I'm going to cover the introduction part. What is cost of capital? There are various methods are there through which we can calculate cost of capital. But before knowing the methods, before knowing all the calculations, before going towards the numerical problems, we must first know what is cost of capital. I hope you know what is capital, okay, and what is its cost. Then we'll see why it is important, what is cost of capital and why it is important for us if we are doing business, or if we are in job also, we are doing job or business. So why it is important and how we can calculate it. So how it helps in investments, how it helps in valuation. Whenever we want to evaluate the price of any asset, we want to know the valuation, that we can know. Whenever we want to assess the performance of our company, so that all we can know with the help of cost of capital. So let's start. Let's see first what is cost of capital, what is the concept. So cost of capital is basically the cost of acquiring the funds. It is the cost of acquiring the funds. Okay, so here I have written everything in very simple language. If you'll see, very simple language it is. Okay, so cost of acquiring the funds. Okay, let's talk about capital first. What is capital? If you want to open a business, or if you need money for doing something big, if you want to open a startup, your own startup you want to open, so for that purpose you need huge amount of money, whether it is online or offline, but you need a platform where you can do something, where you can innovate something. So for that purpose you need money. And suppose you don't have enough money now, but you want to do it, and you have this observation, you have done all the calculations and everything, that if you will open this startup, you will earn enough amount of money and you will cover all your expenses, and you will be able to pay your loans also. So you need money. That means huge amount of capital you need, huge amount of money you need, that is capital. So whenever you want to get something, you have to pay for that. Okay, if you want to purchase something, if you want to purchase clothes, you want to purchase shoes, so in order to acquire that shoes, those shoes, you have to pay something. You have to pay the price what was there in that shoes, you have to pay that. Okay, so whenever you need capital, in order to acquire the capital, in order to get the capital, there also you have to pay something. Agree or not? In order to acquire the capital, there also you have to pay something, otherwise you will not get it. Because whenever we want something, we want to get something, so we need to pay something for that. Okay, so cost of capital, that means cost of acquiring the capital, cost of acquiring the funds. Okay, suppose you need money for your business, and for that purpose you have issued some shares, okay, and you have issued some debentures, and you have taken loans, and there are various options, various sources are there through which you can earn money. I'll make a video on that also, what are the sources available for us through which we can make money. Okay, so we'll see all those things also in after the completion of this topic, cost of capital. So there are various sources, various options available for you through which you can get the capital, you can get the money. You can take loans, you can issue shares, you can issue debentures. So by doing these things you can get money. Okay, so whenever you are getting money, suppose you have taken loan from a bank, you have taken loan. So if you have taken loan, so it's not like that today you have earned money and you don't have to return it. No, today you have taken loan, so on some future date you have to return that amount with the interest. Not just that amount, you have to return that amount with the interest, principal plus interest. We have seen the time value of money there, we have seen simple interest, compound interest, various methods we have seen. So you know these concepts, what I am talking about, principal and interest. Okay, so whenever you are getting money from somewhere, so you have to return it also. Today you are getting money, so on some future date you have to return it, and with the interest you have to return that money. That interest is the cost of getting loan. This is the cost of capital. For debentures also, whenever you are issuing debentures, for that also interest is the cost, and for shares also dividend is the cost. So there are, whenever you are getting money from different sources, whenever you are acquiring money from different sources, so you also have to pay some cost for that. Okay, so that is the cost of capital, the minimum rate of return that the company must earn on its investments. Minimum rate of return the company must earn on its investment to fulfill the expectations of the investors. Okay, so you have taken loan. Suppose you have taken loan, you have arranged money. Okay, you need 10 lakh rupees for your business. So for that purpose you have taken loan, you got 10 lakh rupees, but that 10 lakh you have to return also. So this 10 lakh you will invest in your business, you will do something in which you are good at, you will do those activities, you will earn profit. So whenever you will earn money by investing this 10 lakh, so at least minimum amount you have to earn, because you have to repay this 10 lakh also. Now you have taken this 10 lakh from someone, so you have to pay this 10 lakh, you have to return this 10 lakh to those persons, to those institutions, you have to return it also. So at least this 10 lakh plus whatever interest is there, that is the minimum amount that you have to earn. Okay, so that's why, so that is basically the cost of capital, minimum rate of return that the company must earn. It is compulsory to earn, otherwise they will be in loss, they will not be able to return their money which they have acquired, they will not be able to return it. Okay, so that is cost of capital, and it is important in taking capital budgeting decision whenever we want to know what we have today and what we'll get in future, present and future values, that all we'll get to know with the help of cost of capital. If we know the cost, capital structure, these all topics will come in the next sessions, so don't worry about that. Capital structure also, you want to know the ratio, what should be the equity, what should be the debt in your organization. For that purpose also this cost of capital will be helpful. For knowing about the financial performance of your company, it will be very much helpful, because you will know what you are paying and what you are earning. You will know the cost, you will know the profit, and there are various other things like market value of shares, earning capacity, what is your firm's earning capacity. You will be able to calculate in a year what is your capacity to earn. Okay, so there are various things. Now the cost of capital is named by various other names like break-even rate, minimum rate, cut-off rate, target rate, hurdle rate, and standard rate. There are various names, various other names of cost of capital. So break-even rate also, you may have learned about this earlier, that no profit no loss. Whenever there is no profit no loss, that is break-even point, that is break-even point. Okay, so this is the minimum amount that you must earn, that is cost of capital, because you have to return it to those persons from whom you have taken it. Now let's see the components. There are various components of cost of capital. There are 4 parts of cost of capital. First one is cost of debt. Debt, that means it includes either debentures can be there or loans can be there. Okay, means cost of debt. Debt means it is something that we have to return after some time. It is a kind of loan. Debenture is also a kind of loan. If we have taken it today, so we have to return it out in future. And to those persons or to those institutions from whom we have taken loans or we have issued debentures to them, so we have to pay them interest. So interest is the cost of debt. Okay, now coming towards cost of preference shares. There are 2 types of shares, preference and equity. Preference, for whom we have to give preference, we have to pay them first. Means whenever the company will have profit, they have to give the profits, they have to distribute the profits first to preference shareholders, then to equity shareholders. So it is nothing. Cost of preference shares means if we have issued preference shares, so the persons who have taken preference shares, we have to give them return. So that is the cost of preference shares. In equity shares also we have to give them return. After distributing preference shares, we have to distribute the profits or whatever their rights are, we have to distribute it among the equity shareholders. So in shares there are 2 things, preference and equity. Preference, we have to give them preference, then we have to come towards equity. So talking about shares, we have to pay them dividends. Dividend is their profit. For preference shares, there is fixed dividend rate is there. So preference shares is always like there will be written 12% preference shares, 10% preference shares, like this it will be written. So that rate is their dividend. Whenever the company will have profit, they have to distribute this percentage amount to that preference shareholders. Then after that, the profit which is left, that will be distributed among the equity shareholders. So this is the cost of preference and equity. Then fourth is retained earnings. Sometimes the company don't distribute the profits, the company don't give interest, dividends, means after doing that also, suppose the company still have some money it has, suppose it has some money which remains with it. So it is company's choice whether it want to distribute everything, to shareholders or to other stakeholders, or it want to retain that. If the company is retaining the profits, that is called as retained earnings. Okay, if the company has earned something and it is retaining that for future emergency, so that is retained earnings. So basically this retained earnings we are keeping with us, we are not giving it to anyone. But if in future, if we want to give bonus to our stakeholders, or if we want to distribute that also, so by assuming that, we need to calculate its cost. Okay, so its cost also will be calculated, that is opportunity cost we calculate for internal funds. So there are these four methods are there through which we will calculate cost of capital. Cost of debts means whatever debts we have taken. Okay, so for debts, the person who are the debenture holders or from whom we have taken loans, they are not the owners. We have to pay them a fixed rate of interest, that is their cost. For shareholders, there are two types of shareholders. Preference, we have to give them preference, we have to pay them dividends first. After when the dividend is left after distributing preference shareholders, then the remaining will go to equity shareholders. And then the cost of retained earnings, whatever the money we have retained with ourselves that we have not distributed, for that also we need to calculate cost. We'll see numerical problems on all these four methods in the upcoming videos. So stay connected and watch the videos. If you have any confusion in any topic anywhere in related to financial management or what I have told you, so please comment. And okay, thank you.